Good afternoon. This is Evan Smith with Stephens Energy Investment Banking Team. We're here for our year-end recap. And before we get into the questions, I'd like to introduce Keith and Brad from our energy team to go through their backgrounds.
Yeah, hi, I'm Keith Behrens, run the Energy Investment Banking Group at Stephens. I've been at Stephens for 17 years now, and looking forward to the discussion today.
Yeah, good afternoon. I'm Brad Nelson, head of the A&D group within the energy platform here at Stephens. Have also been at Stephens for 17 years with Keith.
Great. Well, our first topic today will be on continuation vehicles. And our first question, so continuation vehicle transactions have had an increasing role in the energy space, particularly in the last 12 to 24 months. So what do you guys think the switch has flipped to make these transactions more mainstream or accepted in the market?
Yeah, I think I'll start that and let Brad jump in. There's been about 10 of them done in the upstream space. We've closed 2 of them. The MAP deal we closed earlier this year, which was roughly $1 billion deal. Brad's going to talk about that one. And then we closed the Penn Energy deal here kind of late in the year, which is around $2 billion, the biggest upstream CV done to date. And I think there's a couple reasons, that are a couple factors kind of driving these types of transactions, and in a lot of the cases, and especially like in the Penn Energy case, there was just a lot of upside that wouldn't have been given kind of full value in an outright sale process. And so a CV was kind of a good way to still kind of capture that upside value in the future as kind of the part of this recap transaction. And so I think if there's a lot of upside in a deal or an asset base and you don't think you're going to get full value for that in a sell transaction, it kind of creates a good opportunity in another option for the GP in the company.
Yeah, and to add to that, the CVs, continuation vehicles, they've been happening quite a bit in other industries the last 5, 6, 7 years, and those transactions I think were largely successful. The companies were high quality, so I think that you had some sort of level of case studies in other industries, and the buyers or the investors at that point in time were largely the institutional investors. And a lot of those institutional investors were generalist investors. They were just looking for good ways to deploy capital and then also provide a solution to the companies themselves. And so as basically relative valuation in other industries kept creeping up, the energy industry remained, relatively flat. So I think the institutional investors kind of led that from a demand perspective first. So you started seeing more institutional equity driven CVs happen first. As Keith mentioned, there's been about 10 of them. So you had demand from institutions. And then what I would also say is that family offices started following some of those institutions. So they are just a good fit for some of the issues that some of these companies are dealing with. And also to add on to what Keith said, the CVs are in general a really good solution for companies that have mixed or complex ownership. And so you may have some companies that have ownership where, half the investors are looking for a liquidity event and the other half are looking to stay in. So CVs are a good solution for that.
That makes sense. And maybe diving into a little bit more into the 2 CVs that we've done this year, while all of these deals have similar themes, each of them solve a different situation for the GP. Maybe looking back, what do you think made each of those deals work particularly?
Sure. So we'll start with the first one with MAP. And I kind of alluded to this already. Look, you just had a really, really good company that had, aggregated a big mineral royalty, portfolio over roughly a 35 to 40 year time period. If you looked at the construct of the portfolio, management and ownership will tell you that it was almost impossible to replicate. And so they had a really good platform, providing a lot of cash flow and high growth, on top of it. And frankly, you had some investors that had been in with the MAP team for, roughly 30 years. And quite a few of them were looking for a liquidity event. And so again, it was just a really nice solution where we could kind of hit reset with the company, the new management team. Anybody that wanted to have the option to either stay in the deal, they could. if they wanted to monetize either all or a portion, they could, they were allowed that option as well. So it was just a good solution for a company that had been around for nearly 4 decades and then allowed them to go to the next step.
Yeah, and then the second deal, Penn Energy, that's Penn Energy's a Marcellus player. I think there was a view by the GP and the company that there was going to be rising gas prices, kind of beyond when they were looking to exit, and that's already kind of played out. There's gas prices have gone up since we closed that deal, and they just had a very big inventory of future drilling opportunities, and so when they were looking at kind of the various options, one option is just selling. But they had the management team in place and the inventory position in place. But gas prices really weren't where they wanted them to be, and there was also just a lot of upside that they probably wouldn't have got value for an outright sell. So they looked at doing a CV. We've already seen kind of the thesis starting to kind of happen where you've had gas prices go up like I mentioned, and so that was kind of the reason that they decided to do that deal. I think one other thing I'll mention, in the 2 CVs that we've done, family offices have participated in a big way. So roughly half the equity capital in the MAP deal came from family offices. And then a significant part of the Penn Energy equity commitments came from family offices. And these are perfect vehicles for those types of investors. They have a similar thesis that, hey, if I have a long-term hold, I'm going to catch rising gas prices at some point. They like the fact that there's a team in place, there's drilling opportunities in place. They just need to keep things going, and so it's kind of a perfect scenario for them to make those investments as part of these deals.
And to add to that a little bit, what I would say is the CVs that we've been a part of, and obviously some of the ones that we're aware of, and we're in discussions on some other transactions right now. We're positioning all of these as outright sell sides. So these are not your kind of old school secondaries where groups can get in at a discount to market. Where if you looked at any of the materials, the analytics, how we were thinking about the transaction, they are fair. They're fully valued, fully priced. And from that standpoint, it was just a compelling option for the existing shareholders and management as it related to a sell side valuation.
Yeah, one thing too, to Brad's point, we're talking about, hey, if you went out and sold right now, you wouldn't get full value. But these deals are being done at market valuations. They're not discounted, distressed type valuations. They're compelling valuations, but there's just kind of a piece of, especially in the Penn case, of kind of the upside value that you wouldn't probably get paid for an outright sell, but it doesn't mean it's a distressed valuation. And so just kind of another aspect of these types of deals. And I think too, family offices are kind of important to help drive that outcome. And so there's probably about 15 or so institutional groups that are actively investing in CVs. We're bringing a long list of family offices that like these types of structures, and they help drive competitive tension and really good terms and good valuations in these types of deals.
Yeah, and I think in both cases we found a substantial amount of investors that really appreciated what management had done historically, what the GP had done historically, and were good long-term, essentially holders of the asset class, looking to be in for, call it 5 to 15 years. So again, these were groups that again, the demand was there based on what they had seen historically from both companies.
Yeah, and particularly, I think you see it's a good fit for the families because they're moving away from these more blind pool funds. You get as you guys mentioned, the direct kind of single asset investment and a platform that's established. So makes a lot of sense for those groups. But moving on, maybe more to the strategy and nuance of these deals. We talk a lot about alignment in these continuation vehicles. There's obviously a sponsor in many cases, management, and then the new investors coming in. So how did you see that play out in our deals, and maybe more generally, how do you make sure that alignment is present in these deals?
Yeah, alignment's really important, especially when you have family offices come in and make investments. And in a lot of cases, our family offices are non-oil and gas family offices, and so they somewhat recently decided to invest in oil and gas. They've maybe stood up a small investment team, and, they want to make sure not to, have a bad investment right out of the gate. And so alignment is really important. In the PIN deal, to be specific, the alignment box was checked by INCAP. Their upstream fund 12 making a large investment in that continuation vehicle. They were the second biggest investor in the vehicle. So any dollars that were coming in from any individual investor were probably going to be smaller than the investment that INCAP made. So that's perfect alignment. So that's kind of one key aspect is a GP not only rolling, their investment, not taking any cash off the table, but making an additional investment into the continuation vehicle.
Yeah, look, I think you've hit on something that is key in all these CVs. I think you probably hear alignment more than anything because you obviously have an existing shareholder base, you have an existing GP, you have an existing management team, and then you're also trying to bring in new investors to help facilitate the transaction. So basically, you've got to make all 3 or 4 sets of people, happy with the situation, pleased with the valuation going into the deal. Then you have to have alignment once you have the deal structured between the new investors, the GP, and the management team. You have to set that appropriately to where, everyone feels, again, aligned and feels like management and the GP are incentivized to keep doing what they've been doing. So alignment is probably one of the biggest things that we think about.
Perfect. Stepping back a bit, when you're advising a GP, when we're in discussions and, in board meetings or whatnot, give people maybe a look behind the curtain in our shop as to how we evaluate, which of these deals makes sense to take on, which of these make you say, this fits a CV or this will be a strong fit for our investor sources.
Yeah, good question. I think a couple thoughts are, there's a lot of different, Brad kind of hit on, there's a lot of different parties to the transaction. There's potential conflicts. And the perfect situation is probably where you have a CV valuation that's probably not going to be too far off the strategic sell valuation. Those two valuations are usually, kind of different from the G&A burden, the present value of the G&A burden. And so where you have too big of a difference, the conflicts really kind of come more into play. And so if you look at kind of the secondary play areas where there's just not as active of an A&D market, maybe like the Mid-Con or the Rockies, in a lot of cases, because there's not as active of a A&D market, the two valuations kind of converge. And that's why you've seen so many CVs in those particular areas. And so I think, if you have a Permian deal, for instance, where there's a real active A&D market, you might have too big of a difference between those valuations, which might lead to, hey, let's go ahead and just sell this versus doing a CV.
Yeah, look, I agree with that. I would also say, and this is a little bit cliche, but when a new opportunity comes in our door, the first couple things that we're looking at is management team, what's their history, track record with the asset, and then we're doing a deep dive into the assets. And, we are marketing a lot of these transactions to groups that are certainly energy knowledgeable, sophisticated. And then we're also talking to family offices that are generalist investors. So we have to be able to articulate to them why this is such a compelling story within the energy landscape. And so what I would say is once we're, past the management hurdle and they clearly have a good background, we're looking for an asset base that I don't want to say it's easy to underwrite, but it's not overly complicated. What I mean by that is we're not looking for something that maybe in 4 or 5 basins, kind of hard to pick apart, hard to understand where maybe capital is going to be allocated going forward. So we're looking for, a fairly clean story. Maybe there's a good level of production, cash flow, but there's a lot of repeatable, upside, kind of what we saw in the Penn deal. They had obviously drilled a lot of wells in a very kind of central core area to their property set. And they were basically going to keep doing that with the new capital and cash flow. So from that standpoint, we're looking for a clean set of assets.
Yeah, I would echo that. I think, 1 core area is perfect. two core areas isn't the end of the world, but one core area is probably better. And to Brad's point, you can say, okay, here's our drilling program over the next 3 to 5 years, and we've drilled, 50 wells or whatever it is, that we can look to for analogies, and we're just carrying that forward. And so you can get really comfortable with the well performance forecast. Still got to get comfortable with commodity prices. But again, a lot of these groups really have a bullish view, certainly on natural gas prices. So that part, is a little easier for them to understand. But yeah, simple story, simple asset base, just carrying forward a drilling program that they've been already, they already have several years of history and good results, and they're just kind of carrying that forward. Good alignment, and then an appropriate valuation. Those are all kind of the key boxes to check.
That's great. Well, I think a lot of those characteristics have kind of played into the quality and premium pricing that we've seen in our deals. So maybe touching a bit on that, the price discovery piece of this is always interesting, and you've got GPs with different views on how you go into a CV and LP interest, how they want to approach that as they enter one of these transactions. So what do you guys think works best in terms of getting one of these done at a level that kind of works for everyone?
Yeah, what I would say is, a lot of communication between our team and the existing management team and GP around valuation. So we'll do a lot of work, within our group, kind of come at them with, here's what we think valuation looks like. Here's what we think the market would think about valuation on that particular deal. And so we have a lot of communication with our management team around that. So I would say that's where we start first, is just, making sure that you're in alignment. And what I'd also say to add to that is we almost write the equivalent of a fairness opinion before we go out to market. So we're looking at A&D comps, we're looking at corporate comps, we're looking at NAV, probably leaning most heavily on NAV. So we do a lot of that work, share that with our client, see if we have alignment there. And if we do, then we think we've got a transaction that, the market would like.
Yeah, and usually that's enough, just our views on valuation. I think our clients, put a lot of weight on that. In some cases, it's not. There may be some extra sensitivities where, maybe there's a view, hey, I really want to do a continuation vehicle, but, we need to maybe have a market check on the sale process, just to make sure LPs feel good about, where the CV will get struck versus a strategic outright sell valuation. And so we've done 2 processes now that were parallel processes. We essentially kind of ran a sale process at the same time we were running a CV process, and you frankly can just compare different valuations that come out of each and kind of make a decision on which route you want to go based on, where the bids come in.
Perfect. Well, in terms of, you guys touched on it a bit earlier, but in terms of investor mix, clearly we've seen the family office universe show strong interest here, and we talked about that a little bit, but maybe talk through the broader universe of who's investing in these and why the deal structure is fit for families.
Yeah. So on the institutional side, there's 15 to 20 groups that are active, a lot of household names there. There's some new funds that have popped up that focus on really mostly upstream CVs, maybe energy a little broader, but certainly upstream CVs. So that part's gotten more efficient. And there's probably, again, about 15 to 20. On the family office side, there's probably an equal number of 15 to 20 that can anchor a deal. And then there's 50 to 100 investors that will participate in a deal following a quality anchor. Most of our list is non-oil and gas family offices. Those groups, we have a separate group at Stephens that covers those groups. It's really kind of a financial sponsors coverage group that covers about 400 family offices. They invest 20 to 200 plus million per deal. One thing when you talk about family offices, some people get a little scared. They're like, well, family offices take too long to kind of work through an evaluation. Our experience has definitely been the opposite of that. They do work and they do a typical evaluation. They usually don't have deep teams, and they kind of lean on our team that Brad runs, which is 5 petroleum engineers and 1 geologist, to help them move through an evaluation process in a timely manner. But we have 2 examples of $200+ million investments where family offices, non-oil and gas family offices, from meeting one, before meeting one, they had never heard of the deal, but from meeting one to getting through their investment committee was less than 30 days. So that's moving relatively quick. And again, goes counter to what a lot of people fear about family offices.
One thing to add to that is I might talk a little bit about size of transactions. What I would say, it's going to be a very broad swath here, but a sweet spot in that, call it 2 to 250 million up to $1.5 billion, even up to $2 billion is probably a good swath. And really what you're looking out most for is you don't want to get too small. The reason being is if you're doing a continuation vehicle, and let's say the enterprise value is 250 or 300 million, you may only have half the shareholders selling their stake. So that means you're raising 125 million plus or minus. And so you've got to think about deals that they've got to be sizable enough to where you have a lead investor. Now that lead investor may want to take the whole deal or do the whole deal. But if you're trying to get a syndicate around that, you've got to make sure there's enough capital, enough of a need to where you have a lead investor and then room for a syndicate to follow on. So once you get a little bit smaller than that, not saying it can't get done, it gets a little bit trickier.
That makes sense. Well, wrapping up maybe with one or two more as we look into kind of next year and what we're seeing. Clearly it feels that these deals are becoming part of the standard toolkit for sponsors. It's one method they need to evaluate as part of a number of exit opportunities, exit alternatives that they're looking at. So do you see that trend continuing next year? Maybe just talk through any GP dialogue, or insight that you're hearing with sponsors as they head into next year.
Yeah, I think it's definitely going to continue. It's driven by there's a long list of kind of long in the tooth portcos of the various PE funds. There's I don't know what the numbers are, but there's a long list of 8+-year-old companies that, couldn't sell, or if they did sell, they, maybe wouldn't like their valuations. And so those groups will, a lot of them will look at CVs as an option for an exit and to kind of reset the clock. But there's just a lot of quality opportunities out there. And again, it's got more efficient. So, when we take deals out now, there's more investors to go to, both institutional and on the family office side. It's a great structure. And we'll see. I think we're going to see more of these deals.
Yeah, again, we mentioned it earlier. If you've got a situation where you have complex ownership where some investors are wanting to stay in or someone are wanting to monetize, it's just a really nice solution for that particular issue. And then, as I mentioned earlier, the CV phenomenon is still fairly new for the energy industry. And so, again, it's been happening quite a while in other industries. I think it's going to continue in the energy industry. You're certainly going to see a lot of regular way M&A within our industry, but I do think the CV transaction is going to eat into that a little bit.
Well, perfect. Thank you all for the insight. That wraps our continuation vehicle segment. Thanks for the time.
Appreciate it. Thank you.